What if indigenous banks controlled New World gold and silver, reshaping global finance, trade power, and institutional trust forever? Historically, precious metals flowed outward, centralizing wealth and accelerating extractive institutions across emerging global markets. In this timeline, indigenous institutions retain control, treating gold and silver as regulated monetary infrastructure. Metals back credit systems, trade guarantees, and interregional settlements instead of uncontrolled export extraction. Controlled supply prevents price shocks, avoiding inflationary spirals that historically destabilized foreign economies. Foreign traders negotiate access through goods, technology, and services rather than conquest-driven extraction. Banking councils accumulate leverage, standardizing contracts, interest norms, and cross-border dispute resolution. Without metal windfalls, overseas empires expand slower, constrained by capital scarcity and borrowing costs. Scarcer capital forces disciplined investment, reducing speculative bubbles and reckless overseas expansion. Local reinvestment accelerates infrastructure, education, and urban growth throughout indigenous economies. Wage labor expands earlier, replacing coercive systems with contract-based employment incentives. Accounting, numeracy, and financial governance diffuse widely, strengthening institutional trust across societies. Indigenous banks extend credit abroad, flipping traditional dependency relationships in global finance. Standardized metal-backed currencies emerge, simplifying trade and lowering transaction uncertainty. Wealth concentrates less extremely, narrowing inequality that historically destabilized later financial systems. Technology transfers occur through negotiated trade, not enforced monopolies or violent capture. Early financial regulation emerges, embedding risk controls centuries before modern central banking. Diversified reserves and oversight reduce systemic collapses that plagued later global economies. Global conflict shifts toward trade disputes and arbitration rather than resource-driven domination. Major financial hubs arise outside Europe, redirecting centuries of capital flows. Without extraction incentives, formal colonial structures lose economic justification. Industrialization unfolds slower but broader, aligned with sustainable capital accumulation. Regulated mining reduces environmental damage, preserving long-term productive capacity. This mirrors debates today about resource sovereignty, central banking, and monetary control. Who controls settlement layers controls markets, incentives, and geopolitical leverage. Institutional trust compounds slowly, producing stability that outlasts any single regime. Today's economy appears more multipolar, less unequal, and structurally resilient. Control of money systems often matters more than innovation itself. Small institutional differences compound into radically different global outcomes over centuries. Modern policymakers still wrestle with these same incentive structures today. History's financial architecture quietly shapes possibilities long after events fade. Modern systems quietly trace back to these foundational choices, shaping power and prosperity.